All right. China is already responding to these tariffs. $3 billion worth of U.S. imports, about 138 different products, industries, whatever you want to call it, that the Chinese are looking at here. A good deal of them, we're told, agricultural, although they have alluded to the fact they could be looking at the aerospace industry. That, by the way, might be Boeing, which is why that stock has been under pressure among the Dow 30. To Fisher Investments Executive Chairman Ken Fisher, one of the most successful investors on the planet. We're good to have you.
So good to be with you, Neil.
All right, same here. My big concern with the tariff thing, you and I were briefly touching on it, is that be careful what you wish for, Mr. President. You might just get it. But you think there's something else going on here.
I do, but first, forgetting about what I think, which might be wrong, and I'm not all that important, there is something that's simply important, which is that to move from a world that we've been in to a world that fears what we're doing, which is that tariffs cause recession and you know the rest of the narrative, they miss a simple point, which is that to tip economic growth at 3% into recession, you got to come up with $3 trillion bucks of new global negative GDP. A couple of billion here and there doesn't, it's like throwing pebbles into a lake. People miss the insignificance of the relative scale. People aren't good at scaling. They're missing the point that these tariffs, which are bad, they're wrong, it's a mistake,
right,
aren't big enough to do enough to cause the thing that people are extrapolating.
All right, so if they're at $50, $60 billion, these tariffs, and
$50, $60 billion of tariffs are not enough. You need to come up with several it's bad. Right. You need to, bad is bad.
I know tariffs are bad, and you're right, but should they have been more? Should they have been higher?
Oh, so let's go back to I'm opposed to bad. Bad's wrong, but if you are going to tip into recession, you need to come up with $2-3 trillion of new bad in a world that's otherwise growing at 3% global GDP.
And this is not.
And this isn't going to do that.
So what do you think he's up to? What do you think he's up to?
My basic, I'm listening to Bannon yesterday.
Steve Bannon.
Yes, and Bannon's real clear that Trump can't go meet with Kim Jong-un in current circumstances, regardless of what you'd like to say, because Kim Jong-un can't get out of North Korea, and it's not safe to put Trump there. Once you get that, he's got to put pressure on China. And I see this as a China-Trump classic. Let's get people to look over here while I do this over there, because he's got to deal with North Korea.
So the two of them meet at a neutral location?
He's got to force China to put pressure on Kim Jong-un.
But China's not done it. But China's not done it.
But that's what he's got to do.
You think this is the means?
I think he's trying to push on China. Is it right? Is it smart? Will it work? I don't know. I'm not going there. I don't have a clue. But I don't think this is about trying to promote. I don't think he thinks it hurts him with his base. But I don't think this is about what people think it's about. It certainly isn't enough to cause recession. The stock market, in my mind, is looking like a model-conforming, double-bottoming correction. I mean, you know, looking at the world instead of the S&P or the Dow, you know, we're less than 1% away from creating a double bottom.
And what would that mean? We do that, then what?
Then after that, all these folks that are looking for reasons for the correction, you're looking for reasons where there's not really enough there to matter to a hill of beans. Things get forgotten about over time, and you ramp up off the other side.
But be careful what you wish for, though, right? I mean, I keep saying that with these. I mean, we've had trade wars that have started insignificantly, and they've grown to include other items. This one started, remember, with solar panels and washers from, South Korea, and now it's to include all of these items, and it gets bigger and bigger.
And if that does get bigger and bigger, it is a very bad thing, Neil. We agree on that completely, and I would.
So you tell your clients what these days, Ken? Don't worry about this?
Sit tight for now, because this isn't big enough and bad enough to do enough bad to cause the thing that people extrapolate from it. And in fact, otherwise, things look pretty good. I know yesterday people are upset about the disappointing PMIs. You saw that?
Right.
But the fact of the matter is, disappointing PMIs are still positive. They're just lower than expectation. They're still positive.
Right.
The fact of the matter is they're positive across the board. We have a growing economy.
It continued a trend of things that are getting slower and slower and slower.
So one of my points, and people freak out about Mr. Powell and the Fed,
right.
And I'm not a fan of Mr. Powell. I actually never much cared for the Fed. If it were up to me, we'd do all that differently, but that's not my business, not mine to say. What I will say is that the U.S. yield curve is not nearly as important as the GDP-weighted global yield curve because money floats across borders pretty darn freely these days. The cost of moving money for major entities from this country to that country to the other country isn't big enough to stop the money from flowing downhill like water runs in a stream. And the fact of the matter is the global yield curve has been not shifted really at all over the last 6 months, GDP-weighted global yield curve.
Right.
And that's the one that matters. The fact
even though it's flattening fast here.
It's flattening here, but it's been steepening in places overseas to offset it.
But
so that
in the past, when it's flattened here, I understand, but you're not worried about what's happening here.
I'm worried about the global yield curve because money will just move around the world.
Okay.
And the fact of the matter is, most of the time, yes, it's an argument against America. You're absolutely right about that. Most of the time, when it flattens here, it also flattens everywhere else. I mean, that's the traditional pattern we've seen most of the time.
Right.
And that, if it flattens everywhere, that's bad. But because money floats, it's really the global you want to. There's this age-old saying. You've heard it forever. We've all heard it forever. Think global first. Focus local. Think global first. People have a hard time doing that because they tend to go from the local and extrapolate out. And that's a mistake. It's the wrong way to think.
How do you think for your investors, then? When you look at American companies versus the world, how do you play it for them?
I think badly. The fact of the matter is I'm in a business where if you're right 70% of the time in the long term, you become a living legend. So you better be used to being wrong at least 30% of the time. And so you got to be comfortable being wrong and think about how do I minimize wrongness. And so I got to not overextend. I got to not think too much. I got to try to keep it simple. And this is a bull market. We haven't gotten to John Templeton's famous bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. They do that unless you hit a wallop, which is some $2-3 trillion of new negative bad that comes out of nowhere. A real global trade war in huge scale could do that, but this stuff is just peanuts.